What's going on? Welcome back. Ryan here. In this video, we're talking about cash secured puts. Now, I got my Thinkorswim loaded up, and let's go dive into a chart. Let's just look at Apple. And what I'm first going to preface this cash secured put thing by saying, if you want to buy any publicly traded asset at a discount, you will use a cash secured put. Okay, now let me explain kind of the thinking and the methodology of this so you can really understand how powerful this strategy is, right? So if we're looking at Apple here, and I'm going to bring up a calculator, and right, we're looking at Apple, right? So it's ran up here, right? It kind of found some support here back in October, right? And then it kind of rallied, it rallied $40 almost, right? So when we think about buying assets though at a discount, the reason that the cash secured put allows you to do that is because we're selling a put against an underlying asset, right? So again, remember, if we buy the put, we're buying the right but not the obligation to sell that underlying security, right? So when you buy a put from somebody, right, you're buying that right but not the obligation to sell that underlying security. But the person who sells you that put is the person who is going to buy it from you, right? So for us, if we want to buy assets at discount, well, we can sell puts against them, right? Because what happens is you sell that put and you have one of two outcomes. The put either expires worthless and you keep that premium, right, which gives you a net credit, right? So you're creating income from an underlying asset by selling that put. And on the other side, if the underlying asset trades down into your strike price of the put that you sold, well, if it expires in the money, then you're automatically assigned for shares of stock. You'd be assigned 100 shares, right? If you're trading, if we look at an example on gold, right? If you wanted to get gold at a discount delivered from the COMEX, you could do that by selling a cash secured put against gold futures, where if that put expires in the money, you would then be long one gold futures contract, and then you could decide what you want to do. Now, again, I always like to talk about how you're going to lose money. And when you're selling puts, right, a naked put, a cash secured put, obviously there's a difference between a naked put and a cash secured put. A naked put you could be selling on margin, right? Or you have a certain amount of money in your account, you're selling a naked put, but you don't have the cash in the account to pay for taking delivery of the security, right? So as an example here, if we look at Apple, $176.28. So $176.28. And maybe let's say that you love Apple and you think Apple is going to continue to go up. And maybe you have however much money you have, right? 100 shares of Apple at this price, right? Times 100 shares. We're talking about, to sell a cash secured put against Apple, you need to have $17,628 in your account so that you could take delivery of that 100 shares should the put end up in the money, right? But when we think about getting it for a discount, how do we think about this, right? So 176 and 28 cents, right? Let's just say that we wanted to try to get Apple at a 10% discount from its spot trading price, right? So this is what it's trading out now, times 10%, right? right? So we would want a discount of $17.63 approximately, right? So 17.63. So we take the price minus 17.63, and we could see that, okay, if we were to get a 10% discount from its spot price right now, we would be looking to target around a price of $158.65, right? So let's think about this. When we come into the trade tab, and now we're looking at Apple, and obviously when we're selling puts or we're selling options, we want to be able to get enough premium. And when we start to think about building a tool set of high value skills, which is trading options and thinking about how these large hedge fund managers do this, and how central banks and other large institutions use these strategies to do these type of trades, we want to think about what this looks like on a balance sheet of like a company, right? Because a lot of the times when we're making money on a month-to-month basis for a client, let's say, we want to be able to target strike prices and be able to get enough premium to generate yield on a large account in a relatively safe way. And if you don't mind owning Apple stock, right, then selling cash secured puts can be a really great way to create income. And we talked about the covered calls before, right, where you own that 100 shares and then you sell the call against it. And now we're talking about the cash secured put, where we have the cash, but we're selling the put and we're planning on taking delivery. And these two strategies combined together is what's known as the wheel strategy, right? Where you sell the cash secured put, you're creating income. If for whatever reason you get assigned, now you're long the shares, and we turn around and we sell the call against it. And we repeat that pattern over and over and over again. And that's what the wheel strategy would be, right? So let's actually, from our example, take a look. So if we're looking at Apple, and obviously it just made a high, it kind of went up here and then it dropped, and I don't have any indicators up here to help me formulate an opinion, but just as an example, for the sake of talking about these cash secured puts, again, a 10% discount would put us around $158. So if we go out 29 days out, right, 29 days, and we can look here and we can see, okay, here's this 160 put, right? Here's 157 and 50 cents, 155, right? This 160 put here with 30 days out, 29 days out, is a delta of negative 0.12, right? So what this is saying we roughly have a 12% chance that this is going to end in the money, right? And on the converse side of that, it's saying that we have 88, right? We have an 88% chance that this is not going to end in the money, right? So if we were to sell just one of these puts against Apple, let's go in the middle of the bid-ask spread, and we'll just analyze this trade again. And we'll come into the risk profile. And now we'll drag this all the way out so we can see what that max loss is, right? Well, again, the max loss is going to be, it's going to be a little bit more than 15 grand, right? Because if obviously the difference between the 160 and the price of where Apple is now, if Apple trades down and then this put is in the money, our max loss would be the strike price that we are long those shares, right, minus 0, right? And we can look in this example that we're only making $92 on this put, right? It's not that much money relative to how much money we have to put up, right? So if we look at this inside of the order confirmation dialog, again, our max loss here is 15,908, which is it's the amount of money we would put up for the 100 shares of Apple at $160, minus the credit that we received for selling the put, right? So if we just look at this, in a different way, because it's saying that the buying power effect on this is it's gonna cost us like $1,906 of margin roughly to hold this cash secured put. But what is that? What is that? What is the math on that? Like, how much are we making cash on cash return, right? Well, if the full max profit of this is $92 divided by $1,906 of margin, right? Sorry, 92 divided by 1906, right? Here's our buying power effect. Times 100%, right? So we're roughly making 4.82% on our cash invested for this cash secured put. Now, obviously, the max loss is more than that, right? If we look at the potential max loss, right, $92 over 30 days if Apple goes to zero, which we know Apple is, the chances of Apple going to zero are very slim. But if we do the math anyways and we say 15,908, right, times 100, now we're making like roughly 0.5% on the full amount of cash that we would potentially lose if Apple went to zero, and we kept this $92 credit. Now, I know that these numbers look small, right? And you're probably thinking, why would I put up $2,000 of margin to sell this $160 put against Apple, where I potentially could go long Apple? And the reason why is, again, we're potentially able to take delivery of Apple at a discounted price, right? So think about this for a much larger account. Like, what if somebody had $5 million, right? They have $5 million and they want to buy Apple stock, right? Like, they want to buy Apple stock, but maybe they think that it's too overpriced right here. So instead of taking this whole 5 million, right, and buying Apple stock up high, you could just as easily take that 5 million and leverage yourself and sell $5 million worth of puts here, right? So let's think about what that math actually looks like. $5 million, right? So if you had 5 million, you're thinking of buying Apple, but you might think it's too high right now and maybe you want to get a discounted price, right? We looked at what 10% off of this price would be, roughly around $160, right? So when we think about $5 million, and the way that I like to do this is I like to think about this in 100 lot increments, right? Because it makes the math easy. So again, at $160, 100 shares of Apple is 16 grand. So we take 5 million divided by 16,000 gives us 312 contracts, 312 and a half contracts. So let's just make the math easy and we'll say 300 contracts, okay? 300 contracts times 16,000 gives us $4.8 million and leaves us roughly $200,000 of cash. Okay? So 300 contracts. Let's actually see what that looks like from a math point of view with this contract though. So if we come in here and we sell, again, we'll do the middle of the bid-ask spread, 92 cents or a $92 credit. And now we do 300 of these. And now let's come in here and look at what this looks like. So again, when we look at this, it's almost $4.8 million, right? Which is what 300 contracts times $16,000 would be, right? But we're taking away our net credit that we would receive for the puts that we would keep if this gets assigned. Okay, but how much money would we make on our investment if Apple never makes it down, right? So if Apple doesn't do anything, if Apple just kind of trades down in a little sideways, right? And now let's say Apple ends at $167 at the end of this period of this put that we just sold. Well, we would keep $27,692, right? And let's see what the buying power effect on this is. So amazing. So again, look, our max loss is $4,772,400, right? That would be the max loss if Apple goes to zero. Our max profit is $27,600. And the buying power effect of this that we would actually have taken out of our account to do this trade is $569,400. So we actually don't even need to put up the full $4.8 million, right? So this strategy of selling cash secured puts can become very valuable once you are commanding the control of a larger account because of your relative percent gain on cash invested. So again, when we look at this from a different way, buying power effect here, obviously the numbers are different, right? It's different for the overall versus the stocks versus the options. But if we just take this buying power effect, which is, let's see what this is. So $27,600, that's the premium we keep for 29 days of a put that we sold. We sold 300 of these over 29 days on a $5 million account where we were thinking of buying $5 million of Apple outright. And instead of taking that whole $5 million and potentially buying Apple at a higher price, we said, well, let's see if we could try to get this for a 10% discount and sell this cash secured put. And if it expires worthless, we keep $27,600, and that would be divided by $569,400, which is the margin we had to put up to hold this, right? Which gives us a cash on cash return of 4.84%. Now, at the end of the day, obviously this is an option masterclass and we're looking at options, but at the end of the day, and what I said before, is we want to buy assets that produce income compounded over time. And this is how some of the largest institutions and the best hedge fund managers use these strategies to do exactly this, right? Because think about it like this. If we put this trade on and we make 4.84% on our money, now our $5 million account the next month is going to be $5,027,600, right? Less the cost of commissions and things like that. And again, if Apple were to trade down right? And now let's say Apple is at $165, right? Just making this up. We did the trade. We sold these cash secured puts. They expired worthless. We made almost 5% on our money invested in 1 month of time. We made $27,000 for that month. And again, so remember, when we were talking about this trade, we were looking at the margin put up and the yield on margin. But let's take a look at another metric where we take the 27,600 and we divide this now by the $5 million account value, right? Times 100%, right? This gives us about a half a percent of yield on a $5 million account. Now, this doesn't look like a lot, but if you did this for the next 30 years on a $5 million account, compounding over time, you would have an incredible amount of money, right? And this is how professionals trade options, right? They use these strategies with large amounts of money, targeting very small gains compounded over time. That's how this works. And that's the mentality that you should have as an options trader, right? A lot of people, again, I said in the beginning that people, they look at the instant gratification. They look at these small monetary gains over a short period of time. And obviously not everybody has a lot of money to start with. And that's what's great about options is it gives you the flexibility to not only have strategies to grow a small account into a large account, but then to turn around with a large account and just compound your money over time forever when you kind of understand how to do this. So again, let's say that trade works out. We kept that $27,600 of premium for those 300 puts we sold. And now Apple is trading down here to 165. Let's just say 165. Again, if we wanted to target a 10% discount on Apple again, it'd be 165 minus 16.5 gives us 148.5. So the next month we could do the same thing. We could come into the trade and we could go 60 days out. Let's go 85 days out, right? And we could target this 145. And we could even sell this now, right? Again, we could come in here and sell this for $100.72 premium. And remember, we have $5,027,600 in our account now, so we have plenty of money, right? If we're thinking about a big account. And the reason why I think I want to explain this cash secured put with a big account is because this is the type of strategy that you're going to use when you are commanding more money, right? So again, we could sell 300 of these. Again, let's look at what this looks like. So the margin is actually less now. And we're taking in, we could potentially make $51,000 in this next month by selling this cash secured put, knowing that we want to buy Apple stock anyways. We want to be long Apple stock anyways, but instead of risking all of our capital for buying Apple outright, well, we could just sell these cash secured puts, and it's actually better because now we're creating income every day because we're long theta, right? Every day that passes by, these options erode away and we keep that money. So again, we can analyze this trade and we'll take these off. And again, the put, it always looks the same, right? Where we have our max loss here. Obviously, if Apple stays above 145, we will keep this $51,600. Now, I've used Apple here as an example of getting a discount on an asset, but let's look at something else, right? So right now, everybody loves silver. On Reddit, there are tons of people who love silver, right? And again, you can use cash secured puts to get discounts on physical commodities that you can take delivery of. And I'm not going to talk about it specifically in this video, as I'm going to leave it for the section at the end of this masterclass that talks about the power of becoming licensed, having a hedge fund where we're able to manage and hedge risk for businesses in the physical world that have price risk based on whatever business they're in. And the great thing about this, and the reason why hedge fund managers who like Ray Dalio and some of these amazing fund managers are able to do what they do, is because they're commodity trading advisors, right? They have the ability to buy and sell futures and options on behalf of clients, hedging their risk and using things like cash secured puts to create income. And there's tons of other things that we can talk about that I'm not going to talk about in this video. But just for an example here, looking at these silver futures, like this, actually we can't use silver because for whatever reason, they have taken these silver future options off of here. I'm not sure if it's just for my account, but if you had an account with an introducing broker or a futures commission merchant, you weren't using TD Ameritrade, and I'm sure I could call TD Ameritrade up and have them turn these options back on. But just for this example, let's look at gold because I know gold has options. So again, let's say that you really love gold, right? And we can see gold here is starting to move up now, right? We're in a period of inflation. Gold could easily rally here and make new all-time highs. And let's say that again, you had $5 million that you wanted to invest into physical gold, right? Well, we can figure this out again by taking the spot price of gold, $18.10 and 10 cents, times the 100 troy ounce contract, right? Which gives us this value of $181,010, right? So if you were going to take delivery of 100 ounces of gold, like a 100 ounce bar, it would cost you $181,010 if you were able to use the futures and buy a futures at this spot price, planning on taking delivery of it, keeping this money in your brokerage account, and then paying for that gold, right? Now, for this example, $181,010. So we have 5 million divided by 181,010. And that means that we could take delivery of 27 contracts. So 181,010 times 27 gives us almost 5 million, right? So again, if we wanted to get gold at a discount from spot, right? Think about all the metal companies out there who sell gold, who sell silver, who are charging over spot price. But now you as a savvy investor, you laugh at these businesses because you now know that you can come straight to the source and you can get gold at a discount below spot, right? This is how the best money managers and the central banks operate, right? Where they're always looking at how can we create income? How can we get things at a discount, right? So let's take a look at this. So we know that we could do 27 contracts from the spot price right now on a $5 million account. And let's say that we wanted to target a 15% discount. So 1810, 271. So 1810 minus 271, 1539, right? So let's go out 22 days, and we can't even, a 15% discount, we're way too far away from the money to have enough premium that would make that worthwhile over 22 days, right? Again, when we think about selling cash secured puts or selling any option, I like to look at delta, right? Because again, delta is giving us an approximate percentage of this option ending up in the money. So based on your risk tolerance is where you would decide how close or how far away to sell this premium, right? So again, let's just look at like this 15 delta, right? So here's this 15 delta, the 1750s, right? So 1750 is down here. It's below this last swing low here, right? So let's say that we wanted to sell that 1750, right? We still wanted to take delivery of 27 contracts of gold, right? Which turns out to be 27 times 100 troy ounces, right? We're taking delivery of 2,700 ounces of gold, right? Times the spot price of 1750, right? Gives us almost 5 million. Again, you know, when we come in here and we look at this 1750 and we sell this, and we're going to sell 27 of these, and let's just target 450, and we'll look at what these numbers are. So again, our buying power, see, this is the great thing about options, especially because remember, we're building a high value skill here. We're looking at some institutional type trades where you as the option trader knows how this works. There's a lot of people who don't know how this works, right? So you might be thinking, why is he talking about a $5 million account if I only have $5,000, $10,000? And the reason why is the conceptual understanding of this is more valuable than your account value that you're trading right now. Because as we'll see when we get to the next section, if you know how to do this and you can go out and get licensed and pass the test and create your relationship with your sponsor broker or whatever area that you want to work in as a professional, you will be able to take this skill set all the way to the bank, because the idea is, again, to have a high level skill like this, raise $1 billion, 1 billion with a B, and then you as that hedge fund manager, you're making a 2 and a 20% performance fee, right? Your 2% management fee, 20% performance fee. And when we do this on very large amounts of money for all different types of clients, you will be very well paid for your high level skill. But again, looking at this example, the great thing about options is the leverage that it affords us when we have the capital in the account to use. So remember, we're trying to buy $4.8 million of gold at a discount, and the buying power effect for selling these puts is only $157,000. So think about what that actually means in terms of the percent return, right? We're getting a $12,150 credit, right? Which might not seem like a lot until we look at that $12,150 credit on the cash that we put up in terms of margin if this expires worthless, right? So 12,150 divided by 157,973 times 100%, right? Again, this is a 7.69% cash on cash return over 22 days of time. Is a really good return, right? And when you compound this over time, we're talking big money, right? Really, really big money. And again, there's no guarantees, right? This isn't trading advice. This isn't investment advice. We're just looking at this high value skill and what cash secured puts are, what you're able to do with them, how this setup kind of works. And the most important thing that I want you to take away from this is that cash secured puts can be used to take delivery of an asset while creating income for yourself, right? You can target discounts. And before I end this video, right? Again, we can look at this gold and we can see, right, what's the max loss on this, right? Again, it's almost 4.7 million, that 2,700 ounces of gold. If gold goes to zero, gold is not going to zero. It's just not, right? Gold will probably never go below $1,000 again, ever, right? The governments have printed too much money. Obviously, cryptocurrency is a huge thing as opposed to gold. But remember, gold is still a $10 trillion market cap, right? There's lots of banks and institutions who are always going to hold gold, right? And now that we know that we can sell put options against it and we can take delivery of that gold, right? We know that we can, potentially make, 7% for a trade like this, right? And when you start to look at the market like this, you're going to think about trading differently, because you're going to realize, wow, if I have this high level trading skill, and obviously I want to grow my own account, I want to manage my own money, but if I know how this works, why would I not just become licensed, go out, raise millions of dollars, and do it with much larger amounts of money, right? And this is how all these hedge fund managers make billions of dollars, right? Because they're using strategies like this along with other strategies, managing tons and tons of money where they're having a management fee for doing this, right? And that's the gift that I'm trying to give you, is to educate you so that you have this high level skill so that you could do anything you want. You don't need me. You don't need people trying to charge you money for trades every month. You are the one who has all the power to do anything you want because you understand the mechanics of how this works, right? So just quickly, we're going to talk about how you lose money selling cash secured puts, right? Again, if you're selling cash secured puts against an asset, if the market makes a fast drop down towards your strike price, those options can balloon in price, and you could actually end up facing a margin call if you don't have enough capital in the account to withstand that variance of the asset fluctuating and your puts losing value, right? Because other people, right, somebody who doesn't quite understand this, they might try to sell a naked put and they don't have enough capital, and then the market drops. Now they're margin called, or maybe they're liquidated with no option, right? They have to buy that put back, for a loss, which is just silly, right? Because if your main idea is that you wanted to take delivery of gold, or you wanted to take delivery of those Apple shares, well, it doesn't matter if the market falls, because you have all the margin and the capital in your account, and you're not going to exit the position for a loss when you could just keep it, keep the position on, keep your premium, take delivery of the shares, then turn around and either wait for it to go back up where you'd make money, or again, you could do like the wheel trade where you then turn around and start selling covered calls against your long position. But again, I hope that this is helping you gain some insight, giving you a different perspective for these markets and options trading. Cash secured puts are extremely important. They're extremely useful, and this is a way that you can essentially get a discount on any asset that you want to purchase outright. Okay, so if you have any questions, reach out. Again, I am so thrilled you're here learning this, applying yourself, because these are these strategies and this knowledge, you can take this anywhere in the world and not only help yourself, but help your friends and your family. And, once you have more confidence, and once if you know and believe that this is what you really want to do with your life, you could then, start a fund, become a manager, and again, have the ability to scale your fund using these amazing option strategies, and you're going to make a lot of money for yourself and for your clients. But again, there are no guarantees, right? I don't know how well you are at managing emotions, right? I don't know much about you quite yet. I really want to know more about my clients, how I can help you achieve your goals, because I really believe that options can change your life. So again, super thrilled that we made it this far. Again, if you have any questions, reach out, and I will see you in the next video.